Okay. Yeah, thank you very much for coming out so early and for putting my paper on the program. So this is a paper that I have. It's entitled Macroeconomic Model with Occasional Financial Crisis. So what's the starting point of this paper? So as you all know, there's been lots of work on this topic after the crisis. And the way I view the literature is that people have mainly focused on finding mechanisms by which negative shocks get amplified. So really focusing on the downturn. And I think it's still an open debate whether the models that have been proposed are actually given enough amplification in order to explain the severity of crisis that you observe in the data without relying on unnecessarily large shocks. And the starting point of this paper is therefore slightly different. So where I start from is from a quickly growing empirical literature about financial crisis. So this literature has contributed a lot over the last 10 years, I think. They've shown very intriguing stylized facts about crisis in the data, mainly relying on historical sources. So Alan Taylor, who's in the room, has contributed a lot to that literature. And what you see across a range of studies is that financial crises, they're not entirely random events. They tend to occur at particular points in the business cycle, and they tend to occur out of boom periods that are particularly credit-fueled, and they tend to occur at the end of prolonged expansions. And secondly, what people have argued is that the ultimate triggers of crisis are not necessarily large. So, for example, Gordon and Organess argue that the losses from subprime mortgage market were actually not that large. So, what you want to have is that a model of financial crisis really has these features that they tend to occur of these boom periods where macro-financial imbalances build up, and then at the end it doesn't necessarily take a large shock to initiate them. So that's of course a big challenge for macro models. And in particular, with respect to the boom that crisis occurred of boom periods, it's a challenge because in standard macroeconomic models, people are risk averse, so they smooth consumption. So when you get a temporary income shock, what you do is you save, and so you lower your borrowing ex ante that you had ex ante. And secondly, asset prices are pro-cyclical. So in good times, asset prices increase. So your leverage measured at market values tends to be counter-cyclical in most models. So what I'm doing here is I'm trying to put down really the most simple model that you can possibly think of where these effects are overturned. And the way I'm going to do this is just by having heterogeneous agents and limited asset market participation, that certain agents can only invest in certain markets. And the line of thought basically goes as follows. So I'm putting out different versions of a model to clearly illustrate to you what the driving mechanisms are. So I start out with the most simple model that I could write down, and it takes you, I think, literally 2 or 3 minutes to put into Dynair if you ever worked with that. And the ingredients are the following. So you have 2 agents, and they're just heterogeneous in their discount factors. So this is like in Kiyotaki and Mu, if you have that in the back of your mind. And one agent will invest in the capital stock, and the other agent will work. And in the most simple model, I keep even capital and labor constant. So in that model, what you will see is that bank leverage is countercyclical. If you just allow for a small tweak, which is to have capital endogenous in that framework, you will be able to actually generate pro-cyclical bank leverage. And I will be matching that exactly to the data. And then in the third model, I want to, so given the first 2 models, I basically generate a mechanism by which leverage can increase in good times. So this is addressing the boom period. And in the third model, what I'm introducing is long-term risky loans and a rollover problem for banks. And what happens there is that at the beginning of a period, banks may have the threat of a bank run. And what they do is that they cut down on their existing investment in order to generate liquidity, in order to prevent the run. But that is particularly costly for the economy because the liquidation of existing investment takes out capital, and a lot of that is lost in the process. So this is going to generate this steep fall in output. Okay, so this is the basic environment. You have a good producer that combines capital and labor in order to produce a good. And that good producer is subject to a technology shock. And so this is the only aggregate shock in the economy. So very, very standard. Secondly, they're households. Again, very simple here. They consume and work, and they can save in a one-period riskless bond, and have to satisfy this budget constraint. So again, very simple here. RT here is the interest rate on saving. It's going to be slightly different than the interest rate on borrowing. And then there's another type of agent, which are banks, and they also consume. They consume their dividends, but they don't work. They invest in the capital stock, and so they receive the returns on their capital investment, and they in equilibrium they will have a lower discount factor than the households. Therefore, they will borrow in equilibrium. And the interest rate that they save on borrowing is slightly different. So they will have this risk premium on borrowing, which is linear in the amount of debt that they have. So what this does is two things. It gives me a unique deterministic steady state, and it has a sensible implication if this psi here is bigger than 0, that the level of borrowing is positively correlated with the interest rate that they pay. And to just have these effects not messing up basically the general equilibrium, I'm going to have them receive the premium just lump sum as a transfer back. And the last ingredient is their capital producer, so they producing new investment in the economy is subject to quadratic adjustment costs, and this gives rise to this price for capital from the first order condition. Okay, so that's already the model. It's very simple. There's one guy that works, one guy that invests in the capital stock, a capital good producer, and a good producer, and that's already it. So what I'm now going to show you is that if you keep capital and labor constant in this economy, so even then some things drop out, what you will have in this economy is that bank leverage is countercyclical. So let me explain to you what it is. So to a positive technology shock, well, you have technology increasing, output and the consumptions are increasing. The interest rate will go down because both agents want to save more. But in equilibrium, one of the two agents can only save more because they are trading in this one-period riskless bond. So what will happen is that in steady state, the bank in this economy has a lower consumption level because they have a lower discount factor. So when they then get a temporary income shock, they're actually the ones that want to save more out of this temporary income shock because they have a much lower level of consumption. And so their borrowing actually for the bank decreases. The price of capital increases. So their leverage, measured as debt over the value of their assets, here assets being held constant, which is the price of the asset, can therefore only decrease. So the leverage is definitely countercyclical in this environment. So then when you allow for one small tweak, which is just to make capital endogenous, you can also make labor endogenous now. That doesn't really change the result. But now something else happens, which is that in good times, the balance sheet of the bank essentially grows because they want to invest more. And they have to take resources from somewhere in order to invest. And what they do is they take simply some of the savings from the households in order to do that. So in that environment, leverage can actually be pro-cyclical. And the strategy that I pursued is to pin that down. So it actually depends on the exact calibration, whether it's pro-cyclical or counter-cyclical. The way I'm going to pin that down is I collect the data on intermediary market leverage, and I'm going to try to match exactly the correlation of that leverage with economic activity that you see in the data. And secondly, I also obtain evidence on how leverage behaves to a technology shock in the data. So first of all, what you see in terms of the cyclicality is that market leverage is very mildly pro-cyclical. So it's just a bit above 0. In fact, this will be enough to generate crisis out of boom periods in the end, in the final model. And I'm going to try to match exactly this correlation coefficient. And secondly, if you run a simple local projection on the intermediary market leverage to a technology shock, what you see is that market leverage initially declines. And that's because of the asset price effect. But then over time, balance sheet grows, and market leverage actually increases over time. So here what I'm going to do is that for given calibrations of the two discount factors, you can match this borrowing cost exactly in order to both get the cyclicality right as well as this impulse response. And here is the result from this calibration. And what you see now is that to a positive technology shock, it's that the bank not saves more, but that they actually take on more borrowing in order to invest more. So you have their debt increasing as well as their capital. And the behavior of leverage is exactly as in the data. So initially, it declines because of the asset price effect. Your stuff becomes worth more. But then you also take on more borrowing and you invest more. So over time, your balance sheet grows. And that is the effect that comes in over time, that leverage actually grows. So if you then take the correlation with that and output, so output basically just goes up as positive and then returns to zero, you have this negative effect initially, but then it tends to be positive. So overall, the correlation is mildly positive. So basically, what I was trying to communicate here is that with this very simple model, you can have some agents leveraging up in good times. And these are particularly the agents in the economy that invest, so what I think of as banks. And now, given that I have this mechanism where leverage can grow in good times, I basically have a way of generating crises out of boom periods. So what I then need, in order to match the facts that I showed you initially, is a mechanism by which I then turn at the end also relatively small shocks into large effects. So what I'm next going to do is I'm going to introduce long-term loans and occasional financial crisis. And to give you the intuition, what's going to happen is that banks, at times, they face a potential risk of a creditor run, and they cut down on their existing investment in order to generate liquidity. So what I need as a model ingredient here is to have a differentiation between newly issued debt and existing debt. So I'm going to have to introduce this maturity of debt and long-term risky loans. So I'm going to have to talk you through that in a second, and then explain to you what generates these rollover crises. So I'm going to introduce another type of agent in the economy that's between banks and the good producer, which are entrepreneurs. So they borrow from the bank and they invest in the capital stock. So here on the right-hand side, so this is their budget constraint. On the right-hand side, you have their borrowing and their net worth, and they take that in order to invest into capital. So here, a new entrepreneur is an entrepreneur that is coming up in a period T and taking up a loan. And they buy this capital, which is then lent to the good producer. And they're subject to a borrowing constraint, which pins down the amount of borrowing that they can get. So that's, for example, as in Kiyotaki. So the loan that they take up has this face value LT nu. So Q2 is going to be less than 1 in equilibrium, and it's backed by the collateral KT nu. And here I'm going to introduce this stochastic maturity in order to give me long-term loans, and again, that differentiates between existing and new credit. And a loan here doesn't mature with a certain probability gamma. So it's similar like price stickiness. Here, it's essentially loan stickiness. So if they don't mature, then what happens is that they simply receive some of the returns that they get from investing in the capital stock. What they do with that is that they simply transfer this back to the household. However, in certain periods, the loan does mature, and when it does, their project ends. So here, the maturity of the project and the maturity of the loan, they coincide. And at that point, they do not only receive the return on the capital, they also sell the capital that they have the remaining, and they receive an idiosyncratic shock on their total profits. So at that point, they can decide, they're forced to repay, and they can decide whether they want to repay or not, so they can make a default decision. And they do default if the idiosyncratic shock is lower than a particular threshold, where that threshold is the exact point where their repayment, the face value of the loan, is exactly equal to the profits that they get. So here, what you have in this model are vintage-specific loans, collateral, and default thresholds. So each loan is unique in the sense that when you take it up, it has a particular value, it has a particular collateral backing it. And then when you go forward, it also has a unique default threshold. because it depends on the loan-to-collateral ratio that you've taken up the loan with initially. And then the aggregate profits determine whether how much you're going to default on that. So that's a rather difficult problem to aggregate, but there is some math in the paper that shows actually how to do that. What changes now is the problem of the bank. So the bank, again, consumes dividends, but now it doesn't invest into the capital stock, but it invests into the whole market portfolio of loans that are out there. Again, there are many different loans from different vintages, and you invest essentially in all of them. And these profits are reflecting this heterogeneity in terms of the loans, where a certain fraction doesn't mature, and you just get each period the continuation value of them, and then another fraction does mature. And here, there are many different loans from different vintages. So this is captured by this omega t, which is their weighted default threshold across all these different loans. So in the paper, I show that one can actually aggregate this problem up because of one particular assumption, which is that this idiosyncratic shock is coming from a uniform distribution, which makes the aggregation feasible. And you end up with these nice expressions where you have essentially AR1 processes in the amount of loans and in their riskiness, which is here captured by the loan-to-capital ratio. But I'm going to leave that more to the paper. OK, so the last ingredient that I have in the model is that banks are now subject to rollover crisis. So again, I've introduced these long-term loans in order to have this differentiation between existing credit and new credit. Now what happens is that each period, banks may face a rollover problem. So at the beginning of the period, households decide whether to roll over their debt. And if they don't roll over the debt and the proceeds that they get from taking over the bank are not enough to cover the outstanding debt, then these multiple equilibria can exist. And it would essentially be a sunspot that tells you whether one of the two equilibria would realize. So this condition, first of all, states that if the amount of outstanding debt is larger than the proceeds from selling the debt, the assets of the bank, where here you have the stuff that matures and the stuff that doesn't mature. And here a key assumption is that when you take over a bank, the things that haven't matured, so the loans that are still remaining, you're going to only get a fraction of the actual value of them by selling them. So potentially because you're less skilled, or people come into a bank, taking over a bank, they don't know exactly what's in the books, so they're not going to get the whole price of these loans back. So if you rewrite this condition, what you will get is that this is satisfied whenever the leverage of the bank exceeds a certain threshold at the beginning of a period. So this is what determines whether these multiple equilibria can exist. So now, first of all, what is the case here is that bank leverage, what was part of my discussion earlier, actually determines the distance to crisis. So it determines whether this is satisfied or not. Now banks, they're risk averse. So when they're insolvent, they essentially don't have any dividends to consume. So they really want to avoid this state. So I give banks the option to prevent a bank run. And they can do it in the following way. They can they can call in their loans that they have issued in the past. They can ask for existing credit to be repaid early, but that is particularly costly because when entrepreneurs, when they have to repay their loans early, they lose a lot of the capital on that. So here, by assumption, they lose a fraction mu of the 1 minus mu of the capital that they had invested. However, what it gives banks a chance is that they can generate liquidity out of that because they demand early repayment, and they will do that in order to prevent the run, and they will liquidate a fraction tau t here exactly that this condition is satisfied, so that they have exactly enough liquidity that this multiple equilibria space isn't existent anymore. So they want to get away from that. But again, this turns a small shock basically into having a large effect. OK. I see I'm running out of time. But let me show you the last result. So here the key parameters to match are both how often crises occur and how deep they are. So above this threshold, above which leverage can get, so that these multiple equilibria can exist. And then secondly, the deepness of crisis is determined by how much capital is lost by liquidating these loans. So I match those exactly to the data. So in the model, crises are as frequent and as severe as in the data. And then I simulate the economy in order to see if I can also match the features of crisis that I put out initially. So the main exercise in the paper is that you simulate the economy for a long period of time, and you now pick out the events where crises occur, and then you look at how the economy behaved around crisis. So here, nothing restricts the model to have crises occurring out of booms or recessions. That's really a feature then of the simulation that will turn out to be the case. So what you can see then is that crises, they tend to occur out of boom periods. So typically before a crisis, technology increases as well as output, capital, and labor, and then they steeply decline when technology returns. However, it doesn't take not necessarily a large shock in order to generate crisis. So this is, in the end, a 1.5 standard deviation shock that generates a crisis, which exactly matches the severity of crisis then in the data. Also, before crisis, you have a credit boom occurring. So more loans are issued with less collateral, and then you see a strong credit crunch then in the crisis when banks are liquidating their existing investment. I think I'm going to leave the rest to the paper and have my discussant take over.